A central bank has answered the call for more stimulus, but it's not the Fed, not the ECB, or the BOE. The People's Bank of China just cut interest rates for the first time since 2008, reducing deposit and lending rates by a quarter point. Stocks are trading higher on the news. Our next guest serves central banks, sovereign wealth funds, and government agencies. Tim Bitsberger is head of official institutions coverage for the Americas at BNP Paribas. So, Tim, we know you're not a self-avowed expert on China, but give us your sense of what it means that the Chinese have now stepped in and, as I say, answered the call for more stimulus.
Right. Well, it's the first rate cut in China in, 3 or 4 years. I think it sends a very strong signal to the marketplace that China is concerned about their growth and that they can do everything they can to kind of manage their growth going forward. I think it's a very strong signal.
And as an interest rate cut, I mean, this is the real deal. It's not what we've seen in the past from China in terms of cutting reserve ratio requirements. How far will it go to pump up markets beyond, say, a few hours today and around the world?
Well, again, I think it shows that China is committed to more global growth. So I think maybe that might help commodity prices. That might help some of those types of markets. But, in and of itself, I just don't know how much markets can react to such a centrally controlled government.
Does it say anything about perhaps some disappointment on the part of the Chinese that we have not seen the ECB take action? Mario Draghi had an opportunity yesterday, and in his press conference, he spoke of the possibility of action in the future, but the ECB did nothing yesterday. The Bank of England had its opportunity today, left its asset purchase program, quantitative easing, intact, not expanding it as some people had expected.
I think China is going to act in China's self-interest. So I think China would have reacted to this regardless of what the ECB or BOE have done. I'm guessing that this was already pretty well baked.
Let's talk about market action out of this. Obviously, we've had risk on for the last 2 days, but just 4 days ago, we were in sort of this disaster scenario and we all had our helmets on. Do you think investors are really going to come in here and buy in a big way? Or is conviction still so low that they're going to sit on the sidelines and take this as positive news, but from the bleachers?
Well, I think when you combine the China move with, I think, the expectation that Bernanke is going to really kind of continue to set the table for more, quantitative easing or more of an Operation Twist later today. I mean, that was pretty well teed up by all the Fed governors yesterday. So I think that, I think markets will breathe kind of a sigh of relief that central banks are reacting. But by the same token, I think your point is correct, and that is nothing is being done to correct the structural problems that exist, in Europe or the U.S.
Based on what the ECB and the BOE did this week, it's clear that monetary policy makers are managing their policy in response to economic fundamentals rather than giving in to market pressure. So why do investors still keep hoping, keep believing that the authorities will come out and give them what they want?
Well, I think the central banks are doing really all they can to deal with the current environment, and I particularly in the U.S. and I applaud them for that. And I do expect some kind of continuation of twist or QE3 down the road. But that being so, I think markets should be pleased that the central bankers are doing all they can. But again, the central banks can only go so far. It's not their responsibility to solve the structural problems in the U.S. or in Europe.
Are you saying that you expect the Fed to make the next move in this global central banking?
I think that, yesterday, to say it got teed up for an FOMC move, for a continuation of twist or QE3 was an understatement. I mean, the drive got hit down the fairway. It's a tap-in birdie putt.
Tim, I want to ask you a question that came up in our interview yesterday with Larry Summers. You're a former Assistant Treasury Secretary for Financial Markets, so very much in your wheelhouse. We were asking Summers about this call that he made earlier this week, the need for the federal government to sell actually more debt because it's so cheap to borrow in real terms that if anything, they should be behaving, Fed Chairman the Treasury Secretary should be behaving like a corporate CFO and terming out his debt as long as possible. Yet at the same time, you have twist, right, which is bringing down interest rates in sort of the 5 to 7 year maturities on the yield curve. Summers acknowledged that effectively the Treasury Department in that regard is fighting the Fed. What do you make of that?
Well, I think, Treasury is terming out their debt. Treasury has consciously extended the average maturity of their debt, and they've been doing that for the past year or two. But I think it's a big mistake for the U.S. Treasury to try to time interest rates. And to say that interest rates, people were saying interest rates were low when 10-year notes were at 2.25. Now they're at 160 something. So I don't think it's the job of the U.S. Treasury Department to make a call on rates.
So not to take it. So you would effectively, I just have to get you to say it. You're disagreeing with Summers in the sense that do not look at 20-year yields, real yields on 20-year government bonds at effectively zero, and sees that as an opportunity to try and sell more debt and do some of the things that he was arguing for, like buying buildings that governments are renting right now.
I think that'd be a big mistake. I don't think the U.S. Treasury should get involved in the investment management business just because they have a low borrowing cost. In fact, I would argue the exact opposite. I would think that low U.S. rates, real and nominal, are kind of masking the structural deficit problem, and that is, interest cost as a percentage of GDP is basically at all-time lows. So that's allowing the U.S. government to actually borrow, so much money, and I think it masks the true structural deficit problem.
All right, then you look in your crystal ball. What's Bernanke going to say today?
I think Bernanke is going to continue to. I think it's going to be a continuation of what we heard yesterday. I think he's going to talk about that the Fed would be willing to act if the unemployment picture doesn't improve, the global situation doesn't improve. I mean, I think the Fed's looking at global growth and sees nothing, where's credit creation coming from? It needs to come from the Fed.
So if investors should be pleased with the fact that central banks are ready to do what they can, have markets, particularly stocks, preemptively rallied on this expectation of stimulus? I mean, will we actually get any more of gains after they actually do something?
Well, to Stephanie's point earlier, I mean, the markets were kind of oversold, and I think there is the expectation that a QE type scenario is on the table. So I think that it's a logical bounce.
But does QE, whether it's coming from China, whether it's coming from the U.S., does it do anything to help the real economy, the global economy recover, or is it just a shot in the arm for markets?
I think it's a little bit of both. I mean, I think what the central banks have to be looking at is the lack of credit creation and the deleveraging that is still occurring. So I think the Fed has to step in and just kind of create credit. And I think that the best way for them to do that is through a QE type scenario.
Tim, great to see you, and thank you for coming. That's Tim Bitsberger, everybody, of BNP Paribas. He's head of official institutions coverage for the Americas.